Hello everyone, my name is Srena Khanal. Today I am going to give a presentation of corporate accounting, and I have chosen a topic of Acrox pharmaceutical company of Australian Security Exchange, which has been recorded in ASX. So here, Acrox is a pharmacy company devoted to the production and commercialization of topical pharmaceuticals. Incorporated in 1998 and using in-house equipment and resources, Acrox has effectively produced and sold a range of pharmaceutical drugs in the US, Europe, and other regions by license. Concept analysis here. Accounting profit is earned by organization found out by reducing the expenses incurred from the revenue earned for accounting period. The revenue earned and expenses incurred for the year is calculated under the generally accepted accounting principle, which is also called GAAP. The second one is taxable profit. Taxable profit is accounting profit adjusted in accommodate some changes in the item of incurred and expense with respect to the local taxation laws. This is the profit based on which a business pays income tax for a period. The third one is temporary differences. Temporary differences are those differences arising between accounting and taxable profit that will reverse as an impact in the future by itself. Thus, this arise as a result of a difference in timing. The fourth one is taxable temporary differences. Taxable temporary differences are timing differences that cause taxable profit in current period to be lower than the accounting profit. As a result, the income tax payable in current period will be lower than the income tax expenses. So temporary differences. Deductible temporary differences are differences that cause the taxable profit to be more than the accounting profit for the current period. As a result, the income tax payable in a current period will be higher than the income tax. The sixth one is deferred tax assets. When a taxable profit is more than the accounting profit, as a result, deductible temporary differences there arise deferred tax assets. So the last one is deferred tax liabilities. When taxable profit is lesser than the accounting profit as a result of taxable temporary differences, there arise a deferred tax liabilities. So now recognition criteria of DTA and DTL. The section of both deferred tax liabilities and assets shall be evaluated along the financial statements unless the organization has the legal right to set off with the two or more same taxation authorities persistence. So deferred tax assets are deducted with the segment for no elongated probability with the relation of the benefit of the tax being realized. Tax expense of firm. Tax expense must be incurred by the Acrox Pharmaceutical to run its daily operation. In the comparison of the previous year, of the tax expenses of the firm has been increased respectively. Accounting income differences. The income of the Acrox company is different as comparing with the two different years. The income statement clearly shows that the revenue of the year 2019 was very better than 2018. Because of the two different account income, the tax expenses will also be different. So the deferred tax assets for the Acrox company in the year 2019 and 2018 are $1,891 and $1,881 respectively. The deferred tax assets are recorded for the purpose of analyzing the revenue of the business and making comparison with the taxation rate. Income tax payable. There is no any income tax payable recorded in the company. The segment of depreciation timing makes the valuation of the amount of income tax expenses and payable to differ along. The deferred timing of the depreciation is also the primary reason of assets and liability valuation differences. Income tax expenses. Yes, the income tax expenses is shown in the income statement, and it is not same with the amount of income tax paid in cash flow. In the cash flow, income tax collected in the cash balance, the income tax expenses is lower than the income tax expenses calculated by adding or lessing of the income tax due by adding or subtracting the increase and reducing the deferred tax reserves. Permanent, temporary, and temporary differences. The permanent differences in a commercial activity which is recorded differently for a financial and tax reporting purpose, and for which the variances can never be removed. Temporary differences arise when there is disparity in the tax base and the bearing number of the assets and liabilities on the balance sheet of the company. Uneven part of finding. Considered charge resources is something contrary to considered charge risk. Thus, they are the explanation behind the decrease in future assessments payable, as an organization had just paid charge on book salary to receive later on, much the same as prepaid duty paid by the organization. So at last, in conclusion, the financial performance of the company here is clearly presented in the report through balance sheet, income statement and cash flow statement, and the financial performance of two different years, that is 2019 and 2018, are compared on each other. The financial performance of 2019 seems better than 2018, and the different taxes area categorized are also been studied. So this was the end of my presentation. I hope you like it. Thank you for watching. Have a good day.